We're going in depth on a crucial ability every trader must develop: recognizing high quality and legitimate change of character in the market. This isn't just another concept, it's the foundational skill that sets the tone for your journey toward becoming a consistently profitable and skilled trader. Without grasping this, you're more likely to get caught in market traps. In this advanced episode, we'll explore multiple variations of change of character strategies and the relevant price action patterns you'll likely see play out in real-world scenarios. But we won't stop there. We'll also uncover the essential guidelines and criteria that help transform a change of character into a setup with strong probability for success. So if that sounds like something that aligns with your trading goals, hit the like button to show your support, and don't forget to subscribe if you're joining us for the first time. Welcome back, traders. Let's dive right in. So, what exactly is a change of character? A change of character takes place when the prevailing market momentum weakens, indicating a possible transition in the overall trend and order flow over time. This formation acts as the initial clue that a transformation in market structure could be developing, hinting at a potential shift in dominance between buyers and sellers, or the other way around. Now let's take a look at how to recognize a valid change of character in the market. In a bearish setup, a change of character happens when the price breaks and closes beneath the most recent significant swing low and the latest demand zone. The same principles are applied in a bullish context. In this case, we observe the market was trending upward, consistently printing a sequence of bullish structure breaks. But then, a shift in market structure emerges as the price drops below the most recent major low and the demand zone, marking the first change of character. The downward momentum builds as price further breaks through the next demand zone and the higher low, triggering a second change of character. This double confirmation points to a likely transition in overall market structure. At this point, we anticipate the market stepping into a bearish order flow phase. Here's an essential concept: each time a zone is broken, a zone on the opposite side automatically forms. Since multiple demand zones have been breached, a new supply zone has appeared at the extreme. As a result, we expect the price to climb toward this extreme supply zone. If price responds to that area, we can initiate short positions in the market. We'll be looking for the price to begin forming a chain of bearish structure breaks moving downward. On the chart, after price interacts with the extreme demand zone related to the change of character wave, it shifts direction, drops lower, and breaks and closes below a newly formed lower low. Then, price pulls back, climbs into another supply zone, reacts, and continues its downward movement by breaking through another structure. As clearly shown, the market's previously bullish structure has flipped to bearish following the formation of the change of character. The market has now entered a confirmed bearish order flow stage. To summarize, a change of character signals a transition in the market's broader trend, either from bearish to bullish or bullish to bearish. Let's examine a market structure similar to the one discussed, where the price has shown a change of character by breaking and closing above this key major high. In addition, we observe the price breaking through the existing supply zone. An important detail here is that price hasn't left behind any unmitigated supply zones. As you can see, all prior supply levels have already been mitigated. This tells us that with the breach of the latest supply zone, a new demand zone is now formed. As stated earlier, when one zone is broken, a counter zone is naturally created. In this case, an unmitigated demand zone has now developed at the extreme. With that in mind, placing a long trade using this demand zone is a strong possibility. There's a significant likelihood that the price will come back down to test this demand zone, respond to it, and then reverse upward. This idea is further supported by the earlier formation of a bullish change of character, signaling that the market structure is likely transitioning into a bullish phase. So here, price has a solid setup to pull back, tap into our newly identified demand zone, trigger our pending buy position, and continue moving higher. Now, let's get into the critical criteria and rules that we must evaluate to properly identify high probability change of character patterns, and understand how to strategically apply them for a trading edge. The first criterion that must be satisfied to recognize a valid change of character is higher time frame mitigation. A change of character is only legitimate when the price reverses and originates from a supply or demand zone on a higher time frame before it breaks a recent major structure, setting the change of character into motion. If the price generates a change of character without touching a higher time frame supply or demand zone, even if there's a valid candlestick formation, it cannot be classified as a valid change of character. This point is extremely important and requires close attention, as it enables us to pinpoint high-probability points of interest and recognize legitimate reversal patterns. It also protects us from being misled by false reversals or deceptive changes in market character, helping us avoid trading in the wrong direction. For instance, picture a bearish market structure where sellers dominate and price forms a sequence of bearish break-of structures alongside supply zones tied to these breaks. Now, in the following setup, price moves upward after a slight rejection from the most recent supply zone. It then breaks and closes above that zone. This brings us to a very common market scenario. Many new or inexperienced traders, who haven't properly assessed the market structure, often misinterpret this upward price movement as a change of character, an indication of a trend reversal. They assume the bearish phase has ended and view this as the perfect opportunity to go long, using the newly formed demand zone as an entry point. They usually set their stop loss just below this fresh demand zone. But things don't unfold as expected. Instead, price makes a minor upward push, mitigates the upper supply, and then resumes its bearish momentum. As a result, those long positions get stopped out. These traders often don't understand why their stop losses were hit, and sadly, they repeat the same mistakes over and over. What they overlooked is a key detail. Price never reversed from any unmitigated demand zone. Entering long trades without price reaching a significant, untouched demand area is premature. The change of character they observed was invalid, the move was simply a liquidity grab. Price used the last supply zone as an inducement zone, collecting liquidity to strengthen its downward continuation. This scenario clearly shows that a poor grasp of market structure often leads to unnecessary losses. Had those traders possessed a sharper read on market sentiment, they would have realized that their identified change of character wasn't valid, since price hadn't touched a higher time frame demand zone yet. Now let's dive into the next confluence factor that boosts the accuracy of identifying change of character patterns, liquidity sweep. To gain further validation when spotting a high probability change of character signaling a potential shift in market structure, we need to observe whether price establishes static liquidity zones around our marked higher time frame areas of interest. We've already gone in depth on static liquidity zones, including their various types and behavioral models, in our earlier episodes. If you haven't watched those yet, I strongly encourage you to go back and study them to build a solid foundation on how static liquidity influences price movement. For now, let's quickly review the essentials. As you already know, static liquidity represents specific price regions where a significant amount of capital tends to accumulate, such as stop-loss clusters, buy, sell orders, and other pending instructions. These zones can appear in different parts of a price chart, but the ones most often observed and practically used are equal lows, equal highs, and dynamic trend lines. These liquidity zones are further broken down into familiar structures like double bottoms, double tops, triple bottoms, and triple tops. We also have bullish and bearish dynamic trend lines, which follow a directional slope and act as magnet zones for price to sweep before a potential reversal. Imagine a scenario where the higher time frame, such as the 15-minute chart, shows a clear downtrend, with the price forming a consistent sequence of breaks of structure, boss, to the downside. After the market taps into a previously established supply zone, it reverses direction and creates a fresh unmitigated supply zone, which is now waiting for a retest or mitigation. At this point, the price begins pushing upward, showing temporary bullish momentum. Now, if we zoom into a lower time frame, like the 1-minute chart, we can observe more granular price behavior and structure that helps us anticipate the next potential reversal or continuation move. As we observe the lower time frame price action, we see that the market begins forming a series of higher highs and higher lows, making its way toward the 15-minute supply zone. Just before price reaches this zone, a double top pattern forms, marked by equal highs, right beneath the supply zone. This pattern accumulates a significant amount of liquidity, resting above the equal highs near our higher time frame area of interest. The price then executes a liquidity sweep, taking out the highs above the double top, taps into the 15-minute unmitigated supply zone, and quickly reverses direction. This reaction is followed by a decisive change of character, confirmed when the price breaks and closes below the most recent major low, including the demand zone that was formed during the earlier bullish break of structure. As previously explained, whenever a zone breaks, an opposite zone is automatically formed. So, since price broke through the latest bullish demand, it established a fresh supply zone, originating from the bearish wave that caused the change of character. At this point, we now have a strong set of confluence factors: mitigation of the higher time frame supply, a liquidity sweep above the equal highs, a confirmed change of character on the lower time frame. With this setup, we can confidently place a sell limit at the extreme high of the newly formed supply zone. The stop loss should be placed a few pips above the zone's high, and take profit can either be targeted at an unmitigated higher time frame demand zone, or the most recent swing low on the current time frame. Spotting a liquidity sweep before price hits your point of interest is a major edge. It validates the strength of your supply or demand zone. Remember, the market needs liquidity to move. If price fails to sweep liquidity before hitting a zone, that zone might be used as liquidity itself, fueling the continuation of the prior trend. So, even if a change of character appears after touching a zone without a sweep, there's still a high risk of price reversing against the new direction, taking out stop losses and invalidating early entries. That's why waiting for liquidity confirmation is key before trading any change of character. Now, let's move into the next set of confluence criteria to further refine high-probability trade setups. Let's move on to the next key confluence in identifying high-probability change of character setups, the double zone breakout. For a change of character, ChoCh, to carry more weight and higher success potential, the price should not only break structure, but also break and close beyond two consecutive supply or demand zones in the same move. This type of aggressive movement strengthens the market's intent and confirms a stronger shift in direction. Let's break it down with an example. Imagine price is trending bullish but begins to show signs of reversal. If it breaks below two stacked demand zones in a single bearish leg, leaving behind noticeable inefficiency, that's your double zone breakout. This scenario offers a strong confirmation that sellers are gaining control. In such cases, it's smart to align with the bearish momentum and look for short setups. Now, suppose we're in a case where only one supply zone has formed and price aggressively breaks and closes beneath two demand zones, creating a clear imbalance. This double zone break adds serious conviction to the bearish intent. What typically follows is the formation of a fresh, strong supply zone at the extreme. This gives you a textbook opportunity. You can set a sell limit order at the extreme of that newly formed supply zone. Price often retraces to fill the inefficiency, tap into the order block, and mitigate the supply, before continuing its move downward. Integrating the double zone breakout, or even multi-zone breakouts, into your trading strategy can elevate your confidence and precision. It gives you a solid foundation to filter false ChoCh setups and commit only to those aligned with clear market momentum and order flow. Now let's break down another common variation of the double zone breakout that you'll often see play out in the market. We're looking at a very similar structure, but with one key difference. This time, the price doesn't break through both demand zones in a single move. Here's how it unfolds. Price initially breaks the last demand zone, which results in the formation of a new supply zone at the extreme. However, instead of immediately returning to that supply, the market stalls and pulls back slightly, but doesn't reach the extreme zone. Instead, price forms a liquidity pool in the form of a double top, which traps early sellers and builds potential energy. Eventually, price continues its push downward and breaks through the next demand zone. And once again, as we've discussed before, this break forms a new opposite side supply zone, this time, just below the double top. In this structure, the upper supply zone remains the extreme zone, while the one formed after the second demand break is referred to as the decisional zone. Warning: important note. Do not enter trades based solely on the decisional supply zone. Here's why. There's a high probability that price will push higher, sweep the liquidity above the double tops, and tap into the extreme supply zone before reversing. If you had entered from the decisional zone, your trade could easily become part of that liquidity sweep, resulting in a premature stop loss hit. Check mark the smarter play. Wait patiently. Allow the market to sweep the liquidity, tap into the extreme supply zone, and then look for valid entry confirmations. This approach protects you from being baited into early trades and keeps your execution aligned with institutional flow. We hope you found this breakdown valuable. If you did, don't forget to hit that subscribe button and turn on notifications to stay updated with our latest price action and smart money concepts. We'd love to hear your thoughts. Drop your feedback and questions in the comments. Let us know what topics you want us to dive into next. Appreciate your support, and we'll catch you in the next episode. Trade smart, stay disciplined.